Imagine waking up one morning to discover that your stock could be forcibly sold. Not because earnings collapsed. Not because management was caught in a scandal. Not because demand dried up or competition surged. But because a small group sitting on an index committee quietly decided to change a definition. That is exactly the situation now facing Strategy, as MSCI considers removing the company from its global equity indexes. And Strategy is not treating this as a routine technical adjustment. In fact, the company has escalated the issue to an extraordinary level, framing MSCI's proposal as a threat not just to shareholders, but to U.S. economic competitiveness and even national security. In this video, we're going to unpack what's really happening here. We'll explain why MSCI is considering removing Strategy from its indexes, what Strategy is arguing in response, and why this decision could ripple far beyond a single stock, potentially impacting Bitcoin, corporate balance sheets, and how traditional finance treats digital assets going forward. Before we begin, a quick disclaimer. This is not financial advice. Nothing here should be taken as a recommendation to buy or sell any asset. This content is for educational and informational purposes only. With that out of the way, let's start with the fundamentals. MSCI, short for Morgan Stanley Capital International, is one of the most influential index providers in the world. While it is no longer part of Morgan Stanley, its reach across global markets is enormous. MSCI indexes are used by institutional investors, pension funds, sovereign wealth funds, and asset managers as the primary yardstick for performance. These indexes don't just measure markets, they shape them. Over $18 trillion in assets are benchmarked against MSCI equity indexes, meaning portfolio performance is judged relative to MSCI's definitions of the market. On top of that, more than $2 trillion is directly invested in ETFs and index funds that track MSCI indexes mechanically. This distinction is critical. When MSCI adds a stock to an index, passive funds must buy it. When MSCI removes a stock, those same funds are forced to sell. There is no discretion, no opinion, no debate, just execution. Even active managers feel the pressure. While they may not be required to track the index perfectly, most are constrained by tracking error limits and performance comparisons. Deviating too far from the benchmark is how careers end. As a result, MSCI's decisions can create sudden, concentrated waves of buying or selling, often compressed into very short time windows. That's why index changes can move stocks violently, regardless of fundamentals. And that brings us directly to Strategy. MSCI has opened a formal consultation to review how it treats a category of companies known as digital asset treasuries, or DATs. These are firms whose balance sheets are heavily weighted toward Bitcoin or other digital assets, often as part of a deliberate long-term capital strategy. Under MSCI's proposed change, any company whose digital asset holdings account for 50% or more of total assets would be excluded from MSCI's global equity indexes. That 50% threshold is the heart of the controversy. Strategy easily exceeds it. MSCI's stated rationale is that some market participants believe these firms resemble investment funds more than operating companies. Since investment funds are not eligible for inclusion in equity indexes, MSCI is questioning whether DATs truly belong in benchmarks designed to represent the global stock market. On the surface, this may sound like a technical classification issue. In reality, it's far messier. The problem is that this test is tied directly to asset prices. Bitcoin is volatile. A company can cross above or below the 50% threshold without changing anything operationally. A price rally alone could trigger exclusion. A drawdown could reverse it just as quickly. That creates instability, unpredictability, and the potential for constant index churn. Strategy, as the largest and most visible corporate holder of Bitcoin, sits squarely in the crosshairs of this proposal. And as expected, Strategy did not stay quiet. In a detailed letter sent directly to MSCI's Equity Index Committee, the company forcefully rejected the idea that it functions like an investment fund. Strategy argues that it is a conventional operating corporation with standard governance, no redemption mechanisms, no management fees, and no obligation to track the price of Bitcoin or any index. Strategy emphasizes that it does not simply buy Bitcoin and sit on it. Instead, it operates an active capital market strategy. The company issues debt and preferred securities, manages liabilities, and deploys capital with the explicit goal of increasing long-term shareholder value. According to management, investors are not purchasing a Bitcoin ETF proxy. They are buying execution, financial engineering, and strategic discretion, along with the potential upside that comes from running this model successfully over time. Strategy also directly attacks the 50% threshold, calling it arbitrary, discriminatory, and fundamentally unworkable. The company points out that many firms operate with highly concentrated asset bases, oil producers, timber companies, real estate firms, without being treated as investment funds. Equity investors, Strategy argues, are always betting on how management allocates and manages assets. Singling out digital assets introduces unequal treatment. Accounting differences make the issue even worse. Bitcoin is fair valued under US accounting rules, while other jurisdictions may allow it to be carried at cost. That means two companies with identical economic exposure could receive different index treatment simply because of where they're headquartered. Then the tone of the argument changes. Strategy accuses MSCI of crossing a line, from neutral market measurement into policy judgment. Indexes, they argue, are meant to reflect markets, not shape them based on subjective views about what constitutes a proper business model. From there, the letter escalates further into national security territory. Strategy frames Bitcoin as foundational financial infrastructure, a scarce digital commodity. In short, Strategy claims that excluding DATs from major indexes would suppress innovation, distort capital markets, and undermine the country's position in a rapidly evolving financial landscape. So what happens if MSCI ignores all of this and proceeds anyway? The immediate impact would be mechanical and brutal. ETFs and index funds tracking MSCI benchmarks would be forced to sell Strategy stock. JP Morgan estimates that MSCI exclusion alone could trigger approximately $2.8 billion in outflows. If other index providers follow suit, total selling pressure could approach $9 billion. Markets rarely wait for the official effective date. Anticipation alone can drive selling. Traders front-run index changes. Funds rebalance early to reduce tracking error. Volatility spikes. Liquidity thins once the passive bid disappears. Beyond price action, there are real consequences for Strategy's business model. The company relies on efficient access to capital. If the stock price falls, its market to Bitcoin net asset value compresses. Equity issuance becomes less attractive. Debt becomes more expensive. The entire engine that funds Bitcoin accumulation slows down. Narratives matter too. Being removed from MSCI becomes a headline that bears can weaponize, regardless of whether the company's fundamentals changed overnight. As for Bitcoin itself, the impact would likely be indirect rather than immediate. Strategy would not suddenly be forced to sell BTC, especially given recent capital raises that cover obligations well into the future. Looking ahead, MSCI's consultation remains open until the end of the year, with final conclusions expected in January. Any changes would take effect during the February index review. It is a test of whether traditional financial benchmarks can evolve in a world where digital assets sit on corporate balance sheets, and whether legacy market structures are prepared for what comes next. And that's why the clash between Strategy and MSCI may end up being one of the most important structural debates in crypto and global finance today.